We ready to say that? CVP analysis. And this is the study of the relationship. This is the study of the relationship. This is the study of the relationship existing. This is the study of the relationship existing between. This is the study of the relationship existing between cost, comma, volume, and profit. Cost, volume, and profit. Full stop. Traditionally, it was known as break-even analysis. Break-even analysis. Traditionally, it was known as the break-even analysis. Break-even analysis. Full stop. CVP analysis is analyzed as follows. CVP analysis is analyzed as follows. We have for this product, then we have the multiple product. Certain condition, certain single product, certain condition. Single product, certain condition. And that's what we call deterministic condition. Right? And this is applied where the company, and this is applied where the company produces and sells, where the company produces and sells, where the company produces and sells only one type of product, produces and sells only one type of product. Only one type of product, and all the factors affecting profitabilities, and all the factors affecting profitabilities, and all the factors affecting profitability are well known in advance, and all the factors affecting profitabilities are well known in advance, and remains constant, over the year, and remains constant over the year, and they remain constant over the year. Good. So now let's look at assumptions of CVP analysis. Assumptions of CVP analysis. Number one, the relationship between cost, volume, and profit is linear. The relationship between cost, volume, and profit is linear. Number two, demand is equal to supply. Demand is equal to supply. Number three, No limiting factor. No limiting factor. Another one. Fixed cost remained unchanged. Fixed cost remains unchanged. Fixed cost remains unchanged throughout the period. Fixed cost remains unchanged throughout the period. Another one. Selling price and variable cost. Selling price and the variable cost. Selling cost and the variable cost remains constant. Selling price and variable cost remains constant. Another one. Technology level remains constant. Technology level remains constant. Technology level remains constant. Another assumption. Total cost can be objectively separated. Can be objectively separated into fixed and variable costs. Into fixed and variable cost. Into fixed and variable cost. Into fixed and variable cost. Good. I will do the analysis. Number one, how do we get the contribution margin? Contribution margin is the difference between the selling price and the variable cost. Then number two, how do you get the contribution margin ratio? Contribution margin ratio. To get the contribution margin ratio, you take the selling price minus variable cost over selling price, which is the same as selling price minus variable cost is the contribution margin over the selling price. Then number three, how do we get the profit? Now for the profit, A, you can use units, or number B, you can use the revenue, that is in shillings. So to get the profit, you take the contribution margin, you multiply by the number of units minus the fixed cost. In shillings, you take the contribution margin ratio, you multiply by the revenue minus fixed cost, where X means the number of units, R means the revenue, F is the fixed cost. And then number four, how do we get break even? We get the break even point. That's the BEP. So to get the break even point, that's the BEP. Now for BEP, get a break-even point, that is XBE, you take the fixed cost over the contribution margin. In shillings, you get number five. How do you get the sales or the profit to earn target? Profit at the target revenue. Also, in this case, you can compute it either in shillings or in units. A in shillings. So here we'll be taking the fixed cost of the target. Lastly, number 6, how do we get the margin of safety? Margin of safety, MOS. Also, for the margin of safety, you can compute it in the based on units. Now, in units, to get the margin of safety, you take the number. Get the margin of safety, you take the revenue minus revenue to break even. Handout page 4, question 1. Handout page 4, question 1. Handout page 4, question 1. A company produces and sold 4,000 units at a selling price of 50. So the selling price is 50. A variable cost per unit was 20 shillings, and the fixed cost was 75,000. The target profit is 60,000 required. The profit made in units and in shillings, the profit made. So here you can use the number of units or in revenue form to determine the profit. Yeah, units in shillings. Though for profit, it will mean to be the same. And so number A, we get the profit. Now to get the profit in units, profit, when you use the number of units, you take the contribution margin, you multiply by the number of units, you deduct the fixed cost. Where the selling price is a selling price, I mean contribution margin is the selling price minus the variable cost. Now the selling price is 50. Variable cost we have is 20. That's how we get the contribution margin per unit. And then we produced 4,000 units. And then you deduct the fixed cost. So the fixed cost was 75. That's how we get the profit. You get 45,000. Or alternatively, you can use the revenue to determine the profit. How can we get that? So in this, the profit, you take the contribution margin ratio, you multiply by the revenue minus the fixed, where contribution margin ratio is that's like cost over the sale. variable cost 20 over the variable cost 3 over 5, you get 0.0. That's the contribution margin ratio. To get the revenue, revenue is the price times the quantity. The selling price is 50. X is the number of units. We sold 4,000 units. That means the sales was an amount of, is it 200? 400. Therefore, to get the profit, you take the contribution margin ratio, which is 0.6. You multiply it by the revenue. We have is 200,000. And then you deduct the fixed cost. So the fixed cost we have is 75. You should be getting the same amount. 45. Number B of the question. Number B, to get the break-even point. B. Now, at break-even, the profit is 0. That means the total revenue is equal to total cost. So for us to break even, how many units should we sell? So you can compute in units or in revenue form. BEP in units is denoted by XBE, which is the fixed cost over the contribution margin. Fixed cost we have is 75. Contribution margin is the selling price minus variable cost. So how many units should we sell for us to break even? 2,500. Now, this is the number of units we must sell for us to break even. That means any quantity above, remember our X was 4,000. Any units above 25 is what you call the margin of safety. What about in shillings? So in shillings, RBE, you take the fixed cost over the contribution margin ratio, which is 75. Contribution margin ratio was 0.6. In terms of revenue, how much should our revenue in order to break even? 125. Good. Then number C, to get the margin of safety, MOS. Now the margin of safety in units form, you take the total number of units minus units to break even. X, the number of units is 4,000, but for us to break units to break even is 2,500. Any unit above the break even, that's what we call the margin of safety. Those are the units that now you'll start to be realizing the profit, which is 1,500 units. What about in shillings? To get the margin of safety, you take the revenue, that's the total revenue, you minus the revenue required to break even. Our total revenue was 200,000, but for us to break even, RBE, our sales should be at least 125. So anything above 75, 125, which is 75, will be our margin of safety. Yeah, that's what we call the profit region. And then lastly, number D, and the sales to earn the target profit. Sales to earn the target profit. So in this case, we'll be taking the fixed cost over the target profit over the contribution margin. Fixed cost is 75, but we have a target profit of 60,000. So for us to achieve a profit of 60,000, how many units must we sell? So contribution margin is 50 minus the variable cost, 4,500. So that means we have to increase our production. Currently, we produce 4,000. But in case our target, for us to achieve our target of 60,000, a profit of 60,000, we must sell 4,500 units. What in terms of revenue? In terms of revenue, it's the fixed cost over the target profit over now the contribution margin ratio. You take the fixed cost, which is 75. Our target profit is 60,000. Contribution margin ratio was 0.6. Therefore, for us to break even, our sales should be 225,000. Good. You can copy. Let's hurry up. So number 2 is the multiple product certain condition. See that? This is applied where the company, this is applied where the company, this is applied where the company produces more than one product. It's applied where the company produces more than one product, and the factors affecting profitability, and the factors affecting profitability, and the factors affecting profitability are well known in advance, and the factors affecting profitability are well known in advance, and they remain constant, over the analysis period, and they remain constant over the analysis period. They remain constant over the analysis period. Another point, fixed cost is applied as a single amount. Fixed cost is applied as a single amount. Fixed cost is applied as a single amount for the benefit of all the product, for the benefit of all the product, for the benefit of all the product. So therefore, the fixed cost will be applied as a single amount. Then it is that. Another point. The assumption noted earlier, the assumptions noted earlier, the assumptions noted earlier are also applicable here, are also applicable here, are also applicable here. And the additional assumption is that, and the additional assumption is that, and the additional assumption is that, additional assumption is that the sales mix will remain unchanged. Sales mix will remain unchanged. Sales mix will remain unchanged. The sales mix will remain unchanged. Full stop. The concept of weighted average, the concept of weighted average, the concept of weighted average will be applied for both, will be applied for both. The concept of weighted average will be applied for both contribution margin and contribution margin ratio as follows. The concept of weighted average will be applied for both contribution margin and contribution margin ratio as follows. As follows. If the company is producing, for example, two products, A and B, so to get the weighted average contribution margin, you take weight of A, contribution margin of A, weight of B, contribution margin of B. Then to get weighted average contribution margin ratio, you take weight of A, contribution margin ratio of A, weight of B, contribution margin ratio of B. November 2015, question 3B. So you got that. Tamu Catering Services sees the market opportunity to supply ready meal to XYZ Limited Airline. The meal are served to passengers as part of the in-flight services under two categories, namely economy class and business class. So we have economy class and we have the business class. Now we can see that let's economy class be A, business class B. An analysis of the results for the financial year ended 31st of October 2015 for each of the categories are as shown below. So you have the economy and you have for the business, the number of meals. Now the number of meals will represent the number of units. That will be X, write it as X. Then we have the sales. Now if you have the sales, we can be able to determine the selling price. So to get the selling price is very simple. A and B. A is the economy class. The total revenue was 350, for B was 980 by the number of units. Business was 7, and that's how you get the unit. It's 115. Then we have the costs. The cost, we have the ingredient, which is variable. Labor is fixed, admin is fixed. So how much is the variable cost per unit? So the variable cost per unit, we do the same. We have A and we have B. And the only variable cost here we have is 175. This is 560 million, but we need per unit. You divide by the number of this 3.5, this is 7. Plus 1 is 15. This one is 8. Yes. $140. Okay. Then we have the fixed cost, but you have said that fixed cost is applied as a single amount for the benefit of all the product. So we get the total fixed cost. There is no fixed cost per product. Now, in this case, the fixed cost will be applied as a single figure for the benefit of all the products. Now we have the labor which is fixed for 175 million. The other one is 560. Also, at profit. I'm getting an amount 10.5. And then we have the total cost and the profit or loss. Additional information. The fixed cost, the unit cost and the prices applicable to this business have been stable. So we have been stable, that means they are certain. Have been stable and are expected to remain as such for the foreseeable future. So therefore, it's a multiple product certain condition. Number 2, the cost of ingredient are identifiable directly to each category, are identifiable directly. Therefore, they are variable. 3, other costs, that's labor and admin, are common to both categories and have been allocated to the two categories in proportion to the total number of meals sold each year. 4, the business could expand beyond its present volume without incurring any increase in fixed cost. The fixed cost would also not change if either of the two categories was abandoned. Required, number 1, the total sales required to break even. So they never specified whether in units or in shillings, but we can compute both. First of all, let's determine the contribution margin. Contribution margin is the selling price minus variable cost. A, B. Selling price is 100. This is 140. Minus the variable cost. This is 50, and this is 80. Contribution margin is 50, and this one is an amount of 60. Then we also get the contribution margin ratio, which is the selling price minus variable cost over the selling price, which is the same as contribution margin over the selling price. So we get the contribution margin ratio for A and B. A, you take the contribution margin, the selling price. This is 100, this is 140. This one will get 0.5. 0.4. But if we have more than one product, the concept of the weighted average will be applicable. The concept of weighted average. First of all, determine the weights. To get the weight of units, A, number of units. A, the number of meals was 3.5. The other one is 7. So it's 10.5. Now let's convert that one. I think this is a third, is 0.33. This will be 0.67. So therefore, how much is the weighted? So we get weighted average contribution margin. You take weight of A, contribution margin of A, weight of B, contribution margin of B. And weight of A, we have is at that 0.33. Contribution margin of A, we have it's 50. Weight of B is 0.67. Contribution margin of B, we have is 60. So how much is the average? 56 point? Give me 2 decimal places. 0.7, okay. So margin ratio of A, weight of B, contribution margin ratio. .33. Contribution margin ratio for A is 0.5. B, it's 0.67. Ratio for B, it's 0.43. So what do you get? 0.45. Answer the question. Now the question was required, number 1. The total sales required to break even. So you can compute both in units and shillings. So in units, you'll be taking fixed cost over weighted average contribution margin. The fixed cost, you already have the total fixed cost, which is 1065. Weighted average contribution margin we have is 56.7. Sorry? 0.7? 8 million, yes. Fixed cost? Sorry? Right. Ereba. Oh, it was supposed to be the fixed. And 110 plus 220. So give me the total fixed cost. get 540. So therefore, our fixed cost will be 549.5 million. Then we get in shillings. To get in shillings, we take the fixed cost of the weighted average contribution margin ratio. So it's 540. And now the weighted average contribution margin ratio is 0.45. That's 1,200. Number two. And the total sales are required to earn a revenue of 300. So how do we get the sales to earn the target revenue? Sales to earn so can copy. May 2014, question 3C. May 2014, question 3C. May 2014, question 3C. A company sells two products, X and Y, with a contribution margin ratio of 40% and 30% respectively. For product X and Y, and you are given the contribution margin ratio. And the contribution margin ratio is 40% and 30%, 0.4, 0.3. And the selling price of products are 54 per unit for X and 25 for Y. So selling price, this is 50, that is 25. Fixed cost amount to 720. The fixed cost is 720 a month. And the monthly sales average units of X and 40 Y. That is the number of units, X and Y. 30,000 units. Why we are selling 40,000 units. Required. Assuming that 3 units of product X are sold for every 4 units of Y. So that's what we have, 3:4. Calculate the sales volume in shillings and in units necessary to break even. So we need break even. So for us to get BEP in shillings, XBE will be fixed cost over, since we have more than one product, is weighted average contribution margin. In shillings, we by RBE, they will take the fixed cost of the weighted average contribution margin ratio. We already have the contribution margin ratio. What we need is the contribution margin. So how can we get that? How can we get the contribution margin? We have the contribution margin. So to get the contribution margin for X and Y, we have the contribution margin ratio is 0.4. This is 0.3, and we have the selling price. So you multiply by 50, you multiply by 25. That means it's 20, and here you have is 7.5. That's how we get the contribution margin. So we get weighted average contribution margin. So you take weight of X, contribution margin of X, weight of Y, contribution margin of Y. And how do we get the weights? These are the weights. 3, this is 4. You get 7. 3/7, 4/7. 0.43, and this is 0.57. So therefore, weight of X is 0.43, contribution margin X is 20, weight of Y will be 0.57, contribution margin of Y will be 7.5. What do you get? 12.875. Now, can you compute the break-even units? So that's our weighted average contribution margin. Let's get the weighted average contribution margin ratio. We do the same. Weight of X, which is 0.43, margin ratio X. Now, these are the contribution margin ratio, which is 0.4. The other one is 0.57 contribution margin ratio of Y, it's 0.3. So how much is the weighted average contribution margin ratio? 343. Now the question was, assuming that 3 units of product X are sold for every 4 units of Y, calculate the sales volume in shillings and in units necessary to break even. So number one, break even point, number one in units, and then in shillings. This is fixed cost over the weighted average contribution margin, fixed cost weighted average contribution margin ratio. We have the fixed cost is 720. Weighted average contribution margin we have is 12.875. This will be 720. Weighted average contribution margin ratio is 0.34. 58? 252.43. 20? Sorry? 99? 125. These are the units, these are shillings. Number 2, yes? Sorry? The first one is? 55? 924 units. Number 2, calculate the margin of safety in shillings. Margin of safety. So the margin of safety in units, you take the number of units minus the number of units required to break even. So the total number of units we have is 40. So it's 30 plus 40, which is 70. That's the total units. But for us to break even, the break-even units, the break-even point in units, we must set a total of 55,922. Anything above is the margin of safety. 0? 7, 8. Good. So we can copy.
In the 3 units of product X are sold for every 4 units.
It's not irrelevant. So that's what we are saying. 3 is to 4. For every 3, you sell 4. Remember, you see that one of the additional assumption is that the sales mix does not change, and the sales mix does not change. So open November 2017, question 1B. November 2017, question 1B. Solid Limited produces and sells 3 products, A, B, and C. So therefore, we have a multi-product. Solid Limited has contract to supply product A and B, which will trace all the specific material that are available to make these 2 products during the next period. The revenue that this contract will generate and the contribution to sales ratio of product A and B are as follows. So you have the revenue and the contribution to sales ratio. That's what we call the contribution margin ratio. Additional information. Product C will generate a contribution to sales ratio of 25%. Now that's the contribution margin ratio for product C. That's the third product. The total fixed cost of Solid Limited are 5.5 million during the next period. The management have budgeted to earn a profit of 1 million. That's our budgeted profit required. The revenue that need to be generated from product C for Solid to achieve the budgeted profit. How much should be the revenue to be generated by product C for us to achieve our budgeted profit? So how do we get the profit? Profit is very simple. You can take the revenue or based on the information given here, you have the total, we have the contribution margin ratio. So first of all, let's get the total contributions. To get the total contribution, we have A, B, and C. A, the revenue is 10 million. B is 20 million. Now C, that's what we need. Can we do that? The revenue that need to be generated from C. So the revenue by C is our X. But what we need is the total contribution. We are given the contribution margin ratio. Product A, the contribution margin ratio is 15%. B, the contribution margin ratio is 10%. Then C, you are told number 1. Product C will generate a total contribution to sales ratio of 25%. This is 25%. 15% of 10 million. This is 1.5 million. This is 2 million. This is 0.25x. Give me the total. It will be 3.5 plus 0.25x. This is our total contribution. But we need the profit. So to get the profit is very simple. You take the total contribution and then you raise the fixed cost. Yeah, if you take the selling price minus variable cost, what we get is the contribution margin. If you multiply by the number of units, that's how you get the total contribution margin. So therefore, to get the profit, remember you take the selling price minus variable cost. Selling price minus variable cost, we get the contribution margin per unit. Then you multiply by the number of units to get the total contribution. That's what we have. And then we minus the fixed cost to get the profit. We have the profit and our target profit. Number 3, the management have budgeted to earn a profit of 1 million. So this is 1 million is equivalent to the total contribution. B1 is equals total contribution is 3.5 plus 0.25x. We minus the fixed cost. Note number 2. The fixed cost of Sol is 5.5. So you minus 5.5. So Bring the right term together. Take this to the other side. This goes to the other side. So it will be 1 plus 5.5 minus 3.5. What do you get? Get 3 is equal is x 0.25, 0.25. 3 times 4. So for us to achieve the target profit of 1 million, we should generate a revenue of 12 million from product C. So you can copy. So number 3, we look at now single product uncertain condition. Certain conditions. Let us see that. This is applicable. This is applicable where the company. This is applicable where the company. This is applicable where the company is producing only one product. The company is producing only one product. And the factors affecting profitability are random, and the factors affecting profitability are random, i.e., they keeps on changing. They keeps on changing. Full stop. They keeps on changing. Full stop. The concept of normal distribution. The concept of normal distribution is applicable. The concept of normal distribution is applicable where the probability is required. Where the probability is required. Where the probability is required. Yeah, so whenever there is uncertainty, we apply the concept of normal distribution. So we do an illustration. Handout page 7, question 5. Handout page 7, question 5. Question 5, we are told that Drones Limited is considering the possibility of adding a new 12 tons Fuso lorry to its vehicle fleet. It bases its pricing and cost calculation on the expectation of running the vehicle on an average of 3/4 loaded at 500 kilometers per week over 40 weeks of the year. Past experience shows that for a variety of reasons, there is a standard deviation of 60,000 tons per kilometer per annum. The company intends to charge 45 shillings per ton per kilometer. So more of selling price. So we'll be charging 45 per ton per kilometer. Variable operating cost is calculated at 40.5 per ton per kilometer. So the variable cost you are given is an average of 40.5. That means the contribution margin per ton per kilometer, it's 45. You'll get 4.5. And the fixed cost is 585,000 per annum. It's 585. Now read that question again. Read that question again. Now the question is, calculate the break-even point for operating the lorry, BEP. So BEP is the fixed cost of a contribution margin. We have the fixed cost of 585. Contribution margin per unit we have is 4.5. Good. Then number B, calculate the expected annual profit. So how do we get the profit? Profit, you take the contribution margin, you multiply by the number of units, you multiply the fixed cost. Contribution margin per unit we have is 4.5. Then you multiply by X. Our X, they are charging per week per kilometer. Let's do that question again so that we get X. Because they are charging per ton per kilometer. That Unlimited is considering the possibility of adding a new 12 ton. So it's a 12 ton lorry. Fuso lorry with vehicle fleet. It bases its pricing on cost calculation on the expectation of running the vehicle on average of 3/4 loaded. This is a 12 ton, but it will be 3/4 loaded. So you get 3/4 of 12 ton, 3/4 loaded at 500 kilometer. Remember, they are charging per ton per kilometer. So you multiply by 500, loaded at 500 kilometer per week. That's per week. Over 40 weeks in a year, we are looking at the annual profit. Then you multiply by year. That's how you get your X. Remember, our pricing is based on the ton per kilometer per annum. Therefore, 12 ton, but it will be 3/4 loaded. So get 3/4, which is 9. Then 500 kilometers, because you're also charging per kilometer. And then it's per week, over 40 weeks per annum. And then you deduct the cost. Fixed cost is 585. What do you get?
225,000.
Let's do it. Number C. Calculate the probability. Whenever you see the probability, now that's where the normal distribution concept will be applicable. Now to the normal distribution, here we have the X bar. Now our X bar, in this case, will represent our average profit. And this is our average profit, which is 225,000. Then to get the standard deviation, you're getting the given standard deviation, you multiply by the contribution margin. So we agree that the past experience shows that for a variety of reasons, there is a standard deviation of 60,000 tons per kilometer per annum. So standard deviation will take the given standard deviation of 60, then you multiply by the margin per unit, which is 4.5. What question? All right, let's go back to part C. Calculate the probability that the lorry will break even. Now, the average profit is 225 per annum. What's the probability that the lorry will break even? At break even, this is where the profit is 0. If profit is 0, that means below the average. So assume it's there. So this is what we call X1 or our target profit. So at least the lorry will break even. At break even, this is where the profit is 0. At least means the minimum. So therefore, the region of interest should be greater. Now, how to get the probability? Now, Z is always equal to X1 minus X bar over standard deviation. Our X1 is 0. X bar is the average, which is 25 over the standard deviation. Our standard deviation is 270. Give me that into 2 decimal places. The normal distribution, 0.83. Now here you ignore the sign. Negative means it's on the lower side. Positive means it's on the upper side. So we ignore the negative. Now, how do we get this? Now what we need is the probability. This is Z. So we use the normal distribution table to get the probability. So use your past paper. There is a normal distribution curve. The normal distribution curve. For the normal distribution table, this is 0.83. You go where you have 0.8, then you go where we have 3. Give me that probability, 0.83. 0.2967. But this is the probability between 0 and 225. This is the probability we have computed. Between 0 and 225 is the one that is 0.2967. But you know very well that under normal distribution is asymmetrical. We have to part all this is equivalent to 0.5. Therefore, the probability to break even will be taking 0.5, then you add 0.2967, of which will be 0.7967. The probability that the company will break even will be 0.7967. Okay. Part D of the question. I'll just draw the normal curve here. This is X bar. Now, in this case, our X bar does not change the average profit. And then we have a standard deviation of 270, which is the given standard deviation times the contribution margin. So number D, calculate the probability that the lorry will make a profit of at least 120. X bar is 225. This is the average profit. Now we need the probability that the lorry will make a profit of at least 180. 180 in this case is below the average, so it will be on the lower side. We call it X1. So at least that's the minimum. So you shade the region of interest. So to get Z, it's X1 minus X bar over the standard deviation. And so in this case, X1 is 180. So it's 180. X bar is the average is 225 over standard deviation of 70. Into 2 decimal places.
0.17.
17. I say that negative means it's on the lower side, so you ignore the sign. Now this one at 0.17, give me the probability from the table. Probability from the table. Okay. Now this is the probability between 180 and 225. 180 and 225. But you need above the average. Was at least 180. So therefore, to get the full probability, we'll be taking 0.5 and then you add the region of 0.0675, which is 0.5675. Number E, come up with a normal distribution again. This is 225, standard deviation is 270. E, calculate the probability that the lorry will make a profit of at least 300. Of at least 300. At least 300. Now 300 is above the average. So let X1 be here, 300. So at least 300, that means must be more than 300. So you shade the region of interest. So to get Z, it's X1 minus X bar over the standard deviation. X1 is 300. X bar is 225. Standard deviation is 270. 0.28, which is positive. Positive means it's above the average. Then read it from the table. 0.1? 0.1064. Now, how do we get the 0.11? So to get the probability, now what we have computed is the probability between 300 and 225. This is what we have computed. And this one, the probability is 0.1103. This is not the region of interest. We need the shaded area. So, but we know that all this, the probability is 0.5. So to get the area of interest, we'll be taking 0.5. Eliminate what we have put in. This probability between 225 and which is 0.1103. We get 0.889. That's the probability that they'll at least make a profit of 300. So you can copy. Lastly, number 4. Multiple products and certain conditions. Multiple products and certain conditions. You see that? The general concept of CVP is applicable, and the general concept of CVP is applicable, except for the computation of standard deviation, except for the computation of standard deviation of the profit, except for the computation of the standard deviation of the profits, In case of two products, comma. So how do we get the standard deviation in case we have product A and B? So we'll be factoring the contribution margin for product A squared, standard deviation of A squared. Then you factor in contribution margin of product B squared, standard deviation of B squared, to contribution margin of A, contribution margin of B, and then you take the correlation between A and B, standard deviation of A, standard deviation of B, all of it, you get the square root. Where R is the correlation between product A and B, between product A and product B. I want us to do a one question on simulation analysis. Yeah, the one we did in for inventory, the objective was to for cost minimization. Yeah, for CVP, we do one in case, CVP is applicable where the factors are uncertain. So it's still under uncertainty. But in this case now, we are using the relationship between the cost, volume, and profit. Now open December 2022, question 2A. December 2022, question 2A. Bring a question on CVP analysis. Lengo Limited is considering marketing a new product. The fixed cost of the product will amount to 5 million. That's the fixed cost. There are 3 uncertain factors. So it's under environment of uncertainty. namely the selling price, the variable cost, and annual sales volume. So we have three unknown factors. Therefore, we prepare three Monte Carlos. The product has arrived of only 1 year, and the various possible levels of these factors together with the estimated probability are given below. So we have the selling price probability, variable cost probability, annual sales volume, and their probability. Those are three variables. Assume that the three factors are statistically independent. Then number two, the company uses the cost volume profit analysis to make this decision. Number three, the following random numbers are provided. So given the random number for each variable required. Using CVP analysis criteria, simulate the problem and determine the average profit. So we're determining the profit. So therefore, under simulation, we see that the first step is to identify the objective, which is the profit maximization in this case. For inventory controls, the objective is cost minimization. For CVP, is the profit maximization. Step number two, you identify the input variables. Here we have three variables. The selling price is unknown, the variable cost, and the sales volume. The sales volume. And then you have the distribution, also known as the Monte Carlo. And we see that the number of Monte Carlo depends with the number of variables. We have three variables, therefore we prepare three Monte Carlos. So the first one is on selling price. We have the amount, probability, we accumulate, then we range 400, 450, 500, 0.3, 0.5, 0.2. And I told you that there is a difference between when you are given 0.3, 0.5, and 0.2, and when you are given 0.30 like that. They are totally different. And this one now what's determined now the use of random numbers. Now look at the random numbers. Now the random number you are given 1, 1, 1. So that means they are in tens. If they are in tens, that's why even our probability you are given 1, 1. So that if you are to accumulate the total, the maximum should go to 10. That is 0.3 plus 0.5, you get 0.8, 0.2, you get 1.0. Then we range. See that when ranging, we use the cumulative probability, assuming they are whole number. This is 3, not 30. This is 8, not 18, and this is 10. So it will be between 0. This is 3 minus 1, you get 2. Start from the next number, 3 to 7, and then 8 to 9. Now is the variable cost. Variable cost, we have the amount, probability, accumulate, and then you range. You have 200, 250, and 300. You have 0.1, 0.6, 0.3, 0.1, 0.7, 1.0, 0 to 0, 1 to 6, 7 to 9. And then lastly, we have the annual sales volume. And so for the sales volume, we have the number of units, probability, you accumulate, then we range. Here you have 40, 50, 60. Hmm? 0.4, 0.5, 0.1 will be 0.4, 0.9. And the first one will be between 0 to 3, 4 to 8, 9, 9. Then the next is determine the logic of the model. So in this case, the objective is to get the profit. So this one will be very simple. To determine the logic of the model, It's all about now what will determine now the simulation worksheet. To get the profit, you take the selling price, you raise the variable cost, you get the contribution margin per unit. Once you get the contribution margin per unit, you multiply by the number of units. That's the sales volume. You get the total contribution. Then from there, you deduct the fixed cost, and that's how you attain your objective. So therefore, step number 5, you come up with the simulation worksheet or the simulation table. Files, 10. So the logic of the model now will define the format of your simulation worksheet so that you take the selling price, there's the variable cost, and if you take the selling price minus variable cost, you get the contribution margin per unit. Once you get the contribution margin per unit, you multiply by the number of units. So we have the sales volume, and that's how we get our total contribution. And then you deduct the fixed cost. That's how we attain our objective by getting the profit. And then we have prepared 3 Monte Carlo. So for each variable in the Monte Carlo, you divide it into 2. Selling price, we have the Monte Carlo, you divide it into 2. One is for the random number, and then the specific amount. A variable cost, we also have a Monte Carlo, a random number, and the amount. Sales volume, we have a Monte Carlo, random number, and the number of units. So we have the random numbers. So 806, 135, 1391. For the variable, we have 043, 467, 2859. Then for the sales volume, we have 636, 94, 097, 685. Now let's get that. So for the selling price, we use the Monte Carlo for the selling price. 8 is here. So this will be 500. 0 is 400. 6, 450. 1 we have is 403. We have 455. 450. 1 we have is 400. We have 450. We have 500. 1 we have is 400. Then for the variable cost, so we use the Monte Carlo for the variable cost. And 0 is 200. 4 we have is 250. 3 is 250. 250, 250, 300, 250, 300, 250, 300. And sales volume, we use the Monte Carlo for the sales volume. 6 will be 50,000. 3 will be 40,000. 9 is 60,000. 4 is 50. This is 40. This is 60. This is 50. We have 50. We have 50. Also, this one is an amount of 50. We get the contribution margin per unit. So take the selling price minus variable. 500 minus 200, you have is 300. Here we have is 150. Here we have is 200. Here we have is 150. Here we have is 200. Here you get is 150. Also, here you have is 150. Have an amount of 150 to 50, 100. So that's the contribution margin per unit. To get the total contribution margin, you take the contribution margin, you multiply by the number of units. 300, and we sold 50,000 units. Is that 15 million? Yes, 15 million. $6 million, 12 million, 7.5, 250 and 50. Sorry? 12? 0.5. This is an amount of 5 million. Then we have the fixed cost. How much is the fixed cost? The fixed cost was 5 million. So each, it's 5 million. That's how we get the profit. So take the total contribution minus the fixed cost. Here we have is 10. Here we have is 1 million. We have 6. We have 2.5. Here we have 3 million. Now we have 4 million. 2.5. 2.5. This one you get 7.50. Now give me the total. Yes. The third one is this one. Total. Profit. Oh, this is 7 here. Give me the total profits. Sorry? 40. So now to get the average, you take the total, which is or the average profit will be all. And that marks the end of that topic. So you can go and try this question. Try December 2021. You can do May 2017. Question 4B.